5 seconds. That's all it takes for your brain to betray everything you know about trading. You've just watched the position turn against you. The market didn't respect your level. Your stop loss has been triggered. Money, real money, your money, has vanished from your account. And in this moment, as you stare at the screen, a war ignites between your rational mind and the emotional storm brewing inside you. What happens in the next 5 minutes will determine whether today ends as a controlled, professional session or spirals into a psychological nightmare that could cost you multiples of your initial loss. The professional trader and the amateur experience the exact same emotion when they lose, the same anger, the same fear, the same momentary self-doubt. But what separates the consistent profitable trader from the one who never breaks through isn't the absence of emotion, it's what happens immediately after that emotion surfaces. This is where the true edge exists in trading, not in your entry strategy, not in your position sizing model, not even in your market analysis. The edge that turns struggling traders into millionaires lives entirely in the psychological space between loss and the next decision. I've blown accounts, I've let single losses turn into week-long disasters. I've felt the sting of watching my dollar amount dwindle and the gut-wrenching confidence drain that follows. But over 20 years, I've also learned that the 5-minute window after a loss contains the most powerful opportunity for psychological transformation in your entire trading journey. What you're about to learn isn't theory, it's the exact mental framework that disciplined long-term market professionals use to protect themselves from the most dangerous entity in trading, their own mind under pressure. Let's dissect what actually happens in your brain and body during those crucial minutes after a loss. Understanding this cascade is the first step toward controlling it. The moment your position closes at a loss, your amygdala, the primitive fear center of your brain, doesn't distinguish between losing money and facing a physical threat. Your body floods with cortisol and adrenaline. Your heart rate increases. Your vision literally narrows. Blood rushes away from your prefrontal cortex, the decision-making center of your brain, and toward your limbs, preparing you to fight or flee. This is the exact opposite physiological state you need for good trading decisions. In this compromised state, your psychology shifts dramatically. The disciplined rules you promised to follow just hours earlier suddenly feel optional. The carefully calibrated risk parameters you established seem overly conservative. The long-term mindset you cultivated starts to collapse under the weight of short-term emotion. Watch what happens next. The amateur trader, still under the influence of this biochemical storm, makes one of two catastrophic errors. Either they freeze, unable to pull the trigger on the next valid setup because fear has paralyzed their decision-making process, or more commonly, they rush into the next trade with compromised judgment, trying to get back what they just lost. This is where the first major psychological fork in the road appears between professionals and everyone else. The amateur asks, how can I recover this money right now? The professional asks, how can I regain my emotional equilibrium first? Think about the millionaire traders you admire. Their secret isn't that they don't experience losses, they absolutely do. Their edge is that they've mastered the psychological reset that must occur between a loss and the next decision. When you operate from a place of emotional disturbance, particularly the dangerous cocktail of fear and greed that follows a loss, your perception of the market fundamentally changes. Patterns that aren't there suddenly appear. Your confidence in your analysis either collapses or, more dangerously, inflates as compensation. Your ability to follow your trading plan with consistency deteriorates. The psychological weight of that initial dollar amount lost begins to exert a gravitational pull on everything that follows. Instead of seeing the market as it is, you see it through the distorted lens of your emotional need. You're no longer trading what's in front of you, you're trading the ghost of your previous loss. I've watched countless talented analysts fail as traders for precisely this reason. They have remarkable market insight but lack the emotional firewall necessary to execute with discipline after taking a hit to their account. The patience required to wait for high-probability setups evaporates. The rules that protect capital get compromised. The long-term perspective that sustains a trading career gets sacrificed for immediate emotional relief. This is why trading psychology, not trading strategy, separates those who generate sustainable results from those who show initial promise but ultimately fail. The path to consistent profitability runs directly through your ability to manage what happens in your mind during this vulnerable window. The most dangerous narrative forming in your mind after a loss is the one that whispers, "You need to make it back." This thought alone has destroyed more trading accounts than any market crash. The moment you begin trading to recover rather than trading your strategy, you've abandoned the only proven path to long-term success. So what exactly do professional traders do in those critical 5 minutes that amateurs don't? The answer will transform your relationship not just with losses, but with the entire psychological foundation of your trading. First, understand this fundamental truth. The professional trader doesn't try to avoid the emotion of loss, they expect it, prepare for it, and have a precise protocol for managing it. While the amateur treats each loss as a surprise betrayal, the professional treats it as an anticipated cost of doing business in the markets. This isn't just semantic difference, it's the cornerstone of a completely different psychological approach to trading. Let me show you exactly what happens in the mind and actions of a disciplined market professional immediately following a loss. The moment a position closes at a loss, the professional trader deliberately disrupts the automatic emotional cascade. They physically stand up from their trading station. They change their visual focus from the screen to a distant object. They take 3 deep, controlled breaths, inhaling for 4 seconds, holding for 4 seconds, and exhaling for 6 seconds. This isn't meditation or mindfulness for its own sake. It's a precise psychological circuit breaker that interrupts the amygdala's hijacking of your prefrontal cortex. By changing your physical state, you begin to change your mental state. The professional understands that trying to make rational decisions while physically maintaining the posture and breathing pattern of distress is neurologically impossible. While the amateur remains glued to the screen, breathing shallowly, marinating in cortisol and adrenaline, the professional trader is already resetting their physiological state. The amateur's money is already lost. Now they're losing their psychological equilibrium too, a far more expensive cost in the long run. Now comes the part that separates millionaire traders from everyone else. Instead of desperately scanning for the next trade or ruminating on what went wrong, the professional trader pulls out their trading journal and documents 3 specific elements of the trade that just closed. 1 was the trade taken according to my established rules. 2 was my position sizing appropriate for my account and the setup. 3 was my exit, whether stopped out or manually closed, executed according to plan. Notice what they're doing here. They're not asking emotionally charged questions like "why did I lose?" or "how could I have been wrong?" They're extracting objective data points that separate the process from the outcome. This is a profound psychological distinction. The amateur trader judges their trading by outcomes. The professional judges their trading by adherence to process. By immediately converting a loss from an emotional event to a data point, the professional trader performs a crucial psychological alchemy that the amateur never experiences. The loss transforms from a threat to identity into information for improvement. This isn't positive thinking, it's ruthlessly practical psychology applied to the reality of trading. Every dollar lost can either be a purely negative withdrawal from your account, or it can be tuition that purchases valuable data about your trading process. The choice is yours, but only if you know how to extract the lesson in those critical moments after the loss. Here's where the professional trader does something the amateur never considers. They zoom out, literally and figuratively. They adjust their chart to a higher time frame than they were trading. They consciously reconnect with the larger market context and their overall trading plan. Why? Because losses create psychological tunnel vision. Your perspective narrows precisely when you need it to expand. By deliberately widening their view, the professional trader is countering the natural psychological constriction that follows a hit to your account. While the amateur remains fixated on the exact price level where they were stopped out, watching it with a mixture of hope and resentment, the professional is already reorienting to the bigger picture. They're asking, based on my overall trading plan, what should I be focusing on now? This contextual reset neutralizes one of the most dangerous psychological traps in trading, the sunk cost fallacy. The money is gone. The professional trader knows that their next decision must be made based on current market conditions and their trading plan, not as a reaction to the previous loss. The psychology of the amateur keeps them mentally anchored to the price where they lost money. The psychology of the professional frees them to see the market as it is now, not as it was when they took the loss. This single shift makes the difference between those who can sustain consistency through drawdowns and those who allow single losses to cascade into account-threatening disasters. Now, the professional trader does something that might surprise you. They deliberately check in with their emotional state. They don't suppress their feelings about the loss. They acknowledge them with ruthless honesty. But they do it with a specific purpose: to assess their psychological fitness for continued trading. They ask themselves, on a scale of 1 to 10, how emotionally reactive do I feel right now? If the answer is above a predetermined threshold, usually a 3 or 4 for seasoned professionals, they have a rule, not a guideline, but a rule about what happens next. They step away from the screen for a predetermined period, or they reduce their position size for the next series of trades, or they switch to a demo account until their emotional reading returns to baseline. While the amateur treats their emotional state as irrelevant to their trading decisions, or worse, allows emotion to completely drive their decisions without awareness, the professional treats their psychological condition as a critical trading metric, just as important as support resistance levels, volatility measurements, or any technical indicator. This isn't about being emotionless. It's about having the discipline to recognize that your emotional state directly impacts your perception of market information and your ability to execute with consistency. The professional trader knows that trading while psychologically compromised is no different than trading while intoxicated. The outcome might occasionally be positive, but the process is fundamentally flawed. In the final minute of this critical window, the professional trader makes a deliberate decision about what happens next. This decision isn't based on emotion, the need to make back money, or random market scanning. It's based on their predetermined trading plan and their current psychological state. There are only 4 possible decisions the professional trader makes. 1. Return to trading with their normal position size because both their process and psychology are intact. 2. Return to trading with a reduced position size because their process was sound but their psychology needs recalibration. 3. Stop trading for a predetermined period because their psychology requires a full reset. 4. Review and adjust their trading plan because the loss revealed a legitimate. Notice what's missing from this list: revenge trading, doubling down to get back to even, randomly hunting for setups that weren't in the original plan, or making impulsive decisions driven by fear or greed. The amateur trader lacks this structured decision framework. Their next action after a loss is usually driven by the emotional residue of that loss rather than a clear protocol designed during periods of psychological clarity. They let the feeling of the moment dictate their trading rather than following the wisdom of their predetermined plan. This single difference, having a specific procedure for the 5 minutes after a loss, creates an entirely different trajectory for the professional trader. While the amateur allows a single loss to infect their subsequent decisions, the professional contains each loss within its own psychological compartment. This is how consistency becomes possible even in the face of the inevitable losses that all traders must endure. What I've just walked you through isn't merely a procedural checklist. It's a fundamental reorientation of your relationship with trading losses. This approach transforms what happens in your mind during the vulnerable period after money leaves your account. The core psychological shift is this: losses don't test your market analysis skills nearly as much as they test your relationship with money, confidence, and self-worth. The professional trader has done the internal work to separate their identity from individual trading outcomes. They don't interpret a losing trade as evidence that they are a losing trader. They interpret it as a normal cost of operating in probability-based environments. This doesn't mean they're complacent about losses. Quite the opposite, they're more methodical about extracting lessons from losses than the amateur ever is. But they do this extraction from a place of emotional stability rather than psychological reactivity. The difference is everything. What I'm describing is not natural. Your brain is hardwired to treat financial losses as threats and to react accordingly. The professional trader has simply built a psychological infrastructure that overrides these default settings during the critical window when these reactions would otherwise hijack their decision-making process. This is the hidden discipline that separates those who make a living from the markets from those who merely visit them occasionally with their capital. It's not about having no emotional response to losses. It's about having a predetermined protocol for managing that response before it manages you. This 5-minute protocol isn't just a technique, it's the foundation of a complete psychological transformation in your trading. When consistently applied, it creates a compound effect that extends far beyond individual trades. It builds the resilience and emotional stability that allow capital to grow over time. What I want you to understand is that losses will never stop feeling uncomfortable. Even traders with decades of experience and millions in their accounts feel the sting when the market moves against them. The difference is that professionals have learned to separate discomfort from decision making. They feel the emotion without being governed by it. Here's the protocol I want you to implement immediately after your very next loss. First, physically stand up and step away from your screens. Take those 3 deep breaths, 4 counts in, 4 counts hold, 6 counts out. Feel your heart rate begin to normalize. Notice the physiological shift that creates space for rational thought. This isn't avoiding the emotion, it's preventing the emotion from hijacking your next decision. Second, document the trade objectively. Was it taken according to your rules? Was the position sizing appropriate? Was the exit executed according to plan? Extract the data from the experience while the details are fresh. This converts the loss from a purely negative event into valuable information that improves your edge over time. Third, deliberately zoom out on your charts and reconnect with the larger market context and your overall trading plan. This counters the psychological tunnel vision that naturally follows a loss and prevents you from making reactive decisions based on a single outcome rather than your long-term edge. Fourth, honestly assess your emotional state. Rate your reactivity on a 1-10 scale. If you're above your predetermined threshold, have the discipline to follow through on your protocol, whether that's stepping away, reducing size, or switching to demo trading until you're back in a state of psychological clarity. Finally, make a deliberate decision about your next action based on both process and psychology, not on the need to recover losses. Remember the 4 options: continue normally, continue with reduced size, take a break, or review your plan. Nothing else. What happens when you implement this protocol consistently is remarkable. Over time, losses lose their psychological power over you. They transform from emotional events into normal business expenses, the cost of operating in probability-based environments. This shift doesn't happen overnight, but it begins immediately with your commitment to the process. The true secret of the millionaire trader isn't that they don't lose, it's that they don't let losses affect their next decision. Each trade exists in its own psychological container, uncontaminated by the emotional residue of what came before. This is how consistency becomes possible in an environment defined by uncertainty. Long-term results in the market aren't built through sporadic, brilliant trades. They're built through thousands of decisions made from a state of psychological clarity. The 5-minute protocol is your path to maintaining that clarity precisely when it's most threatened, after money has left your account. Remember, what separates the professional trader from the amateur isn't the absence of emotion, it's the presence of a system that prevents that emotion from infecting their decision-making process. Confidence in trading doesn't come from never losing. It comes from knowing exactly what to do when you lose. The discipline to follow this protocol when you least want to, when the fear or greed is most intense, when the temptation to break your rules is strongest, is what transforms struggling traders into consistent professionals. This is the psychological edge that no chart pattern or technical indicator can provide. Your journey to trading mastery isn't about eliminating losses, it's about transforming your relationship with them. Start with these 5 minutes. The rest will follow.